Thursday, June 17th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at why I think the dollar is beyond saving. The Federal Reserve is fighting a losing battle. Yes. And by the dollar, of course, I mean the fiat dollar or the paper dollar or the Federal Reserve note, because as many of you know, the definition of the dollar is a weight of silver or even a weight of gold, according to the Coinage Act of 1792. So all that the current dollar is an impersonator, much like those spammers that come on my comment section many times and try to entice people into sending them WhatsApp messages to buy cryptocurrencies and things like that. You see, and that's why gold and silver, they're the real dollar, the real money. And that's why the impersonator, the Federal Reserve, hates it when gold and silver move higher as well. But that's another subject. I'm not concerned about that at all, because we know who the impersonator is here and what the real money is. But yeah, I didn't really follow the press conference by Jay Powell. Just a little bit towards the end. All the Fed did was move a few dots, and these dots are called the dot plot. They are the forecast of each of the FOMC members, who right now number 18. And they give their forecast for the Fed funds rate in a few years. And apparently a few of them moved these dots for the interest rate back into 2023 instead of 2024, and even to 2022. So these are just forecasts by bureaucrats at a central bank. And that's all they did. The Fed, I would say, hasn't been hawkish since the late 80s. And that's one of the reasons why I think the dollar is doomed, because the Federal Reserve, at least back in the day, maybe in the early 80s, still, mid 80s, they still used to do what a central bank is supposed to do to when things get frothy. They pull the punch bowl away, but the punch bowl has been left there for decades. And they keep filling it up. Whenever they see it getting down a little bit, they keep filling it up. So that's the problem. The party's gone on for too long, the frat party. And all that the Fed said yesterday is we are thinking about maybe taking some of the punch out of the bowl in 2022, maybe 2023. But I'm sure if people start drinking the punch too quickly, or the punch bowl gets emptied a little bit, they're going to come and fill it up, because the whole economy, the markets, won't survive without the punch bowl. I follow a lot of people on Twitter, and David Brady, who's at Global Pro Trader. So this is what he said: no taper. Fed continued to buying bonds as is. They didn't announce that they're going to stop the QE. Just a rate hike of 0.25% move forward 1 quarter in 2023. That's the dot plot. Yet bond yields rise, real yields too, at least based on the move in tips. Said differently, nothing changed except the taper risk is gone for now and real yields rise. Well, so there you go. The Fed is really in a quandary. So we're going to go now and look at why I think the dollar is doomed. And to do that, we're going to look back at history, and we're going to take data from the Federal Reserve, St. Louis Fed and the Minneapolis Fed. So first of all, I'd like to show you a chart of the 10-year yield. It says 10-year Treasury, constant maturity date. That's from the St. Louis Fed. It goes back to, let's see, 1962. So if you look back in 1989, around May time, the 10-year yield was trading around 9.32. You might be thinking, wow, where was CPI then? Where was inflation if the 10-year yield was at 9.32? Well, I'll show you where it was. According, this is what, the Minneapolis Fed? Yeah, that's where Neil Kashkari is the one who runs that now. Let's see. Where was CPI in 1989? Oh, 4.8. Where's CPI now? Oh, 5%, right? Where's CPI in 1990? 5.4. Where was CPI in 1991? 4.2. So pretty much where we are right now. The thing is, at the time, the Fed was at least trying to fight some kind of inflation, because as you can see here, the Fed funds rate, which is the short-term rate that the Fed can control, the rate at which federal banking institutions, banks that are controlled by the Federal Reserve, can lend to each other overnight. So Fed funds were just below 10%. I think the target there, Fed funds rate, effective Fed funds rate, was 9.81. So the Fed was keeping the Fed funds rate above the 10-year yield. That's hawkish. You see, that's hawkish. And the Fed was keeping that that Fed funds rate about 4.5–5% above the rate of CPI. So that was the last time the Fed was hawkish. So as you can see, since really the beginning of the century, the Fed is really kept rates artificially low. Yes, they went up prior to the 08 collapse, financial crisis. They went back up to like over 5%, the Fed funds rate. But look what it caused. The greatest banking collapse in history, the greatest housing or real estate collapse in history. So yeah, and there were people like Bernanke who said that the real estate market never collapses. He said that only regional markets collapse. After 08, what the Fed should have done, but they didn't, of course, nor the government. They bailed everyone out, of course, and they had to double down on the dovishness. That's the opposite of being hawkish. You see, Jay Powell wouldn't know what a hawk was if it hit him on the face. So yesterday we saw a lot of people saying that the Fed was hawkish for just changing a dot on a plot in about 2 years' time. It's ridiculous. So as you see now, the Fed's really trapped. It tried again to raise rates from around 2016 to 2019, and we know what happened. We had the Repo-geddon in September 2019. The Fed had to come in again and do this is not QE. And then last year, of course, they had the excuse to throw the kitchen sink at it again. So that's why I think the dollar is doomed. And why is that? Because you could argue if they raise rates, the dollar will strengthen. Well, normally it would in the past, like in the 80s or 90s, because the debt levels were smaller, companies were not as leveraged, consumers were not as leveraged, the government was not as leveraged. So the economy could withstand a rate hike and the dollar would strengthen. But nowadays, the economy cannot withstand a rate hike. It can't even withstand the Federal Reserve talking about moving dots. So there you go. I think the Fed is damned if they do and damned if they don't. Yeah, they can't afford to raise rates. And by continuing the accommodative policy, the dovish policy, they will destroy the dollar. It will be either a hyperinflationary collapse or a deflationary collapse. Back in the 30s, a deflationary collapse strengthened the dollar only because the dollar was as good as gold. Nowadays, the dollar is as good as all this debt that will be annihilated if the Fed even probably thinks about raising rates or changes a few dots on their plots. So that's the situation. Just to finish off, for those people who think there's a crowded trade in commodities, I even heard Jay Powell actually said that he expects inflation or CPI to come down just like lumber prices. Wall Street seems to think that commodities is a crowded trade. But Tavi Costa, who I've interviewed a couple of times on the channel, he knows better. He says here, commodities to equities ratio. So is this really where you want to be? Long stocks or tech stocks or general stocks and short commodities. So as you see here, that this ratio has been the lowest in over 50 years. So crowded trade indeed. So it's 8:01 a.m. London time. Let's check where the markets are. We've got spot gold at 1814. It's up $3. Yes. Gold continued to go lower even after the close of the stock market. They smashed it down on the after-hour COMEX. But am I concerned? No, because as I said, we know who the impersonators are, the fiat currencies, and we know what real money is. So right now, the high overnight has been 1825, the low 1808. Silver was actually outperforming gold most of the day yesterday. And then on the after the close of the stock market at 4 p.m. New York, on the Fin COMEX market, they smashed it down like 40 cents in a minute, down to like 26.50. So that's crazy. Anyway, we're at 27 right now, up 2 cents. Range has been 27.27 to 26.88. Stock markets, of course, were hit pretty hard after the dot plot fiasco. I think the Dow was down as much as 400. Of course, it rallied towards the end of the day because Jay Powell said that the dot plots are not really reliable to look at. So he is trying to backtrack, of course. Right now, the Dow futures down 120. The NASDAQ 100 futures down 77. S&P is down 16. Yes, the dollar did rally strongly yesterday, but I still maintain my view that we are in a bear market, and the top was in 2017, January 2017 at 103.82 as per the dollar index. Right now, sterling is up slightly at 139.95. The euro, which got hit hard yesterday after the FOMC, is pretty much unchanged, just below 120 at 119.84. The dollar is a little stronger from yesterday. I think we're at 110.10 versus the yen right now is at 110.64. And the dollar strengthened as well against the yuan. We're back comfortably above 640. We're at 643. What do I think of this dollar move? Oh, well, I think it's a dead cat bounce. I don't think it's going to last very long. What about the Aussie dollar? Well, yeah, Aussie dollar has been hit hard because investors believe for now that the Fed is going to be really hawkish, that commodities are going to suffer. So we're down almost a big figure from the recent range that we've had above 77. We're at 76.26 Aussie dollar. General commodities, oil, WTI is still pretty firm, down 0.5%, but still way above 70 at 71.52. High grade copper holding here above 430 at 430.32, down 1.5%. Yeah, and the 10-year yield did rally a little bit. I think we were at 150 before the FOMC announcement and the press conference. Right now we are at 156. And don't forget, back in '89, the 10-year yield was at around 9%, and the Fed funds we're almost at 10%. Now we've got the 10-year yield at 1.5 or 156, and the Fed funds are at 0. So yeah, think again before you call the Fed hawkish. As I said, Jay Powell doesn't know what a hawk is, and he's gonna keep the punch bowl overflowing. Actually, it's not even like up to the rim; it's overflowing. And if it stops overflowing, he's gonna put more in. That's the situation, and that's why I think the impersonator dollar is doomed, to go to 0 like all other fiat currencies. So follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.